Right now, as we speak, IonQ stock is trading at $49.52, pushing up against a critical psychological barrier with an intraday high of exactly $50 and a low of $47.24. If you are looking at your screen, you are seeing a stock that is not just moving, it is breathing fire in a market that is otherwise trying to find its footing this Monday afternoon. The volume is heavy, already crossing 10 million shares, indicating that this is not just retail noise, this is institutional positioning. Most people look at a chart like this and see a speculative pop, a classic buy-the-rumor event driven by sci-fi headlines. That is the expectation, that quantum computing is a decade away, and this price action is just froth. The reality is significantly more aggressive. What you are seeing is the market pricing in a transition from research project to commercial necessity. We are seeing a divergence where the smart capital is realizing that while AI was the engine of 2024, quantum is the fuel that keeps it running in 2026. If you are still treating this like a penny stock gamble, you are missing the fundamental shift occurring in the order flow right now. When you look at the broader sector, you might be tempted to compare this to NVIDIA stock, assuming they're running the same race. They are not. NVIDIA built the chips that made AI possible. IonQ is building the compute density that will make AI viable when silicon hits its physical limit. This morning's price action, up roughly 5%, while the broader tech index is mixed, tells us that the market is finally waking up to the bottleneck problem. Traditional computing, even with the best GPUs, is hitting a wall in drug discovery and material science. IonQ is not just selling a faster computer, they are selling the only exit ramp off that highway. The specific catalyst driving this volume today is not just vague hype, it is the convergence of two massive news items that dropped recently. First, the partnership with CCRM to advance regenerative medicine. This is not a someday pilot program. This is a direct application of quantum simulation to biological systems, an area where classical computers fail miserably. Second, the acquisition of Skyloom Global. Why does a quantum computer company need optical communications? Because the future is not just one quantum computer, it is a network of them. By acquiring the ability to link these systems via photonics, IonQ is quietly building the Internet of the quantum age before most competitors have even stabilized a qubit. Let's talk about the actual mechanics of this trade. If you are holding this in a Schwab Intelligent Portfolios account or trading actively on interactive brokers, you need to watch the $50 level like a hawk. We tested it today. We rejected off it. That is normal. That is technically healthy. What you want to see is a consolidation above $48.50. If the stock can hold that floor into the close, it sets up a massive breakout wedge for the rest of the week. The bears are shorting this specifically because they believe the valuation has detached from revenue. They're looking at the price-to-earnings ratio and laughing. But trading quantum stocks on PE ratios is like trying to value Amazon in 1998 based on book sales. It's the wrong metric. You need to value this on technical milestones and partnership density. Speaking of platforms, I know many of you use the Robinhood app or SoFi Invest for these high beta plays. The temptation on those platforms is to use market orders because the interface is so fluid. Do not do that with IonQ. The spread can widen instantly when high-frequency algorithms step in. Always use limit orders. If you are using Fidelity Investments or their Fidelity trading platform, take advantage of the Active Trader Pro tools to watch the Level 2 data. You will see massive sell walls sitting at $50.50 and $51. Those are not retail traders. Those are algorithms programmed to cap momentum. The moment those walls vanish, the squeeze is on. We need to address the pure play argument. When you look at Apple stock or Google, they have quantum divisions, but for them, it's a line item. It's a science experiment funded by iPhone sales or ad revenue. For IonQ, it's the entire existence. This creates a leverage dynamic that is terrifying for the risk-averse, but intoxicating for the growth investor. If Google solves a quantum problem, their stock might move 1%. If IonQ solves it, the stock doubles. That is the asymmetry we are trading here. The risk, of course, is identical in the opposite direction. If the trapped ion technology hits a snag, Apple stock is fine, IonQ is not. Comment below how many shares of IonQ you currently hold and what your average entry price is. Are you holding from the single digits, or did you chase the recent rally? I want to see the sentiment distribution in the comments. Let's shift to the macro picture, because you can't trade this in a vacuum. Interest rates are the invisible hand here. High-growth, pre-profit companies like IonQ are theoretically allergic to high interest rates because their future cash flows are discounted more heavily. Yet the stock is rallying even as the Fed remains cautious. Why? Because the strategic value of quantum supremacy is becoming a matter of national security. The deal with Heaven Aerotech to put quantum tech in drones is a signal. The Defense Department is not buying this for efficiency. They are buying it for dominance. When you see defense applications entering the chat, you stop worrying about a 25 basis point rate hike and start looking at government contract backlogs. If you are engaged in online investing or using investing sites to track this, you might have noticed the strong buy ratings starting to creep in from analysts who were bearish 6 months ago. This flip-flopping is typical. Wall Street hates uncertainty until the moment they can model it. Now that IonQ has a clearer roadmap for their Tempo and Forte systems, the analysts can build their spreadsheets. They can project capacity. They can model the revenue from the Amazon bracket integration. Suddenly, the black box of quantum mechanics becomes a row in an Excel sheet, and that's when the big Fidelity mutual funds and Fidelity ETFs start buying. They need liquidity, and they need a thesis. IonQ just gave them both. However, we must respect the downside. The reality of this technology is that it is hard. We are manipulating individual atoms with lasers in a vacuum chamber. The margin for error is 0. A single report of decoherence issues or a delay in the roadmap can send this stock down 20% in a single session. We saw this with Tesla stock in its early days. Massive volatility based on production targets. IonQ is in its production hell phase. But instead of Model 3s, they are trying to scale qubits without losing fidelity. For those of you managing your own capital through individual brokerage accounts or self-investing, you have to size this position correctly. This is not a set-it-and-forget-it dividend stock. This is a venture capital bet that happens to be liquid. If this is more than 5% of your portfolio, you are not investing. You are gambling. And that's fine as long as you know the odds. But do not look at Schwab Intelligent Portfolios and wonder why they don't allocate 20% to this. It's because the volatility drags down the Sharpe ratio of the entire portfolio. You have to be the active manager here. Let's look at the competition. You have Rigetti Computing and D-Wave. Rigetti is using superconducting qubits, different physics, different problems. They're cheaper, trading at a fraction of IonQ's market cap. But the market is voting with its capital, and right now it's voting for IonQ's trapped ion approach. Why? Coherence times. Trapped ions stay stable longer. It's that simple. In the race to error correction, time is the only variable that matters. If your qubit collapses before you can run the calculation, it doesn't matter how fast you are. This technical nuance is why IonQ commands the premium. You are paying for stability. Now consider the future scenario, the what if that keeps the shorts awake at night. What if IonQ announces a breakthrough in error correction that creates a logical qubit with 99.999% fidelity earlier than predicted? We're talking about a repricing event that would make the current move look flat. This is the ChatGPT moment for quantum. The market is currently pricing in linear progress. Technology, however, tends to move exponentially. If they hit that inflection point in 2025, the institutional chase will be violent. Funds that are currently underweight or have zero exposure will be forced to buy at any price to avoid missing the benchmark. But here is the counter-argument, the